What the hell's going on, guys? So today I'm going to talk to you guys about my fourth highest paying dividend stock. It might not necessarily be the highest yielder in my portfolio. In fact, I know it is not. But it pays me about $300 a year, maybe a little bit more than that, and is essential to my dividend portfolio. It actually has a strangely high yield on cost, so we can kind of get into that and maybe show you guys how I basically got into that point, I guess, if that makes sense. So today we're going to be talking about BHP Billiton, ticker symbol BBL, and if you want to own it I think, in Australia, you actually have to purchase it under BHP. Just small differences between the two. One of them, you have to basically pay a franking tax, which they charge about 15% or so of the dividends associated with that. If you just purchase BBL, which is what I own, you do not have to pay that tax. And so therefore, whatever you get paid out in your American deposit receipts, ADRs, you essentially just get free and clear. Of course, you still have to pay dividend taxes and capital gains and whatnot, but it's not like you're getting hit twice with the franking tax as well as the dividend tax. So BHP is a green part of this pie chart here, which this pie chart shows the essentially the stock weight of my portfolio. So each individual stock that I own is in this little color wheel. BHP is 3.2%. So actually looking at how much BHP is in my portfolio, so we have BHP, you can scroll across here. Current dividend yield is just under 6%. My yield on cost is about 13%. We can talk about that a little bit later. I purchased about 107 shares. I've owned more shares in the past, but I did a cost average through time. I think I started buying in the 40s before, in about 2014 time frame, and throughout time I bought more and more and more. And then basically, once I had 200 shares and I broke even on the first 100 shares, I sold them just because I wanted to employ that capital elsewhere. And I figured, okay, now my yield on cost for these set of 100 shares was about $20. I think I bought some at about mid 20s and others in like the high 18s or something like that. So it evened out to be about $22. Now I've basically grown that to $43. It's based off of great work by BHP and really turning their businesses around and spinning off smaller margin part of their business. So I'm sitting on a decent return associated with that, and a $310 a year for payout. So BHP is a little interesting. We can talk a little bit more about it when we go into the investor report. They just finished their, I think they call it the 2018 earnings. Yeah, so they just finished their 2018 earnings. So we can get into that. But BHP pays out a minimum of 40%, and I think they've raised that now to a minimum of 50% of their earnings per share on a given basis. So they basically said, hey, we're going to pay out 63% of this year's money, which ends up being, I forget what it is, like 63 cents or something like that if you double it, because one ADR is associated with 2 actual shares, so it ends up doubling whatever they say they're going to send out. So I end up with about $2.52 a year if you just double that recent payout. I think it was their highest dividend payout ever or something like that, which was kind of cool. There's a couple graphics in the investor report to look at. So yeah, as you can see, purchasing it around $22 and now having a $2.52 payout, you can understand where you're getting to a high 13 or almost 13% payout ratio. So I kind of skipped ahead. I've already listened to this earnings call. It's really amazing to listen to these CFOs and CEOs sometimes on the call. They just are so able to. They're so articulate, and they're generally speaking, they don't pause and say like or filler words or anything like that. It's just very interesting to hear them talk and not necessarily have those sort of filler words. They really know what they're talking about. They know the numbers inside and out, and hopefully it's somewhere I can get to in the future. Not having to use filler words and stuff like that. And really good person to listen to on conference calls is Bob Iger from Disney. Phenomenal speaker. And you think about it, these questions that they get on these conference calls are absolutely absurd. Like from analysts really trying to trip them up almost and really dig deep into the company. And the responses are absolutely phenomenal. So really able to understand if a CEO knows what you're talking about just by listening to the conference call. And sometimes you see it directly in the share price. It's absolutely absurd. So Andrew Mackenzie's CEO of BHP. BHP, for those of you that don't know, it's an Australian company. They have two headquarters, one in London, one in Australia. And basically, BHP is a minerals company. So it's a mining company, whether it's petroleum, whether it's silver, copper, iron, all that junk. If it basically is a natural resource, they are trying to get after. Simply put, no ifs, ands, or buts about it. So BHP is honestly one of the best places to put your money at the moment. I mean, if you just look at these sort of things, for those of you that know what ROCE looks like or ROCE stands for, I mean, 20% return on all your capital employed. I mean, that's pretty good, especially when you're in a low margin business sometimes like mining can be. So capital discipline over the past couple of years, BHP is really trying to get their debt down relatively great. They're really being capital efficient. I hope that they have some graphs on capital spend that they've had over the couple of years, and they really have a decent pipeline of projects that they're trying to get after. Full year profitability about 24 billion. I mean, that's absolutely phenomenal. And then you think about it, $12.5 billion in free cash flow. That's absolutely absurd. Their net debt is down substantially over the past couple of years to 10.9 billion. Which you think about it, I mean, they're making in 1 year 24.1 billion, free cash flow of 12.5. I mean, they could pay that down relatively quick if they wanted to. So in terms of BHP, a lot of you might be familiar with some of the disasters that have happened in Brazil and whatnot in terms of some of their dams and whatnot that have broken. Unfortunately, natural resources, mining, and even the petroleum industry. Unfortunately, there's a lot of moving parts, a lot of heavy equipment, and unfortunately, some people end up losing their lives, unfortunately. So safety is a huge piece of everything that a lot of these companies deal with. They try their best, and generally speaking, any good company puts safety first and really tries to understand how to make people work efficiently and safely so they can drive down work injuries and days away from work. So definitely see that in BHP. Unfortunately, casualties happen, and they're trying their best to make sure the total injury frequency is continuing to go down. So like I said, they've had issues in the past with two big developments and safety incidents, and here's them trying to make sure that they're doing their due diligence and trying to restore, the environments and everything like that, and also get operations back going so they can provide the natural resources to the people that need them and get their energy. So in terms of financials, I mean, this is a really good piece of business. I mean, you just look at their underlying margins comparing to, their competitors, whether it's Vale or something like that. I mean, they're blowing them out of the water. I mean, 40 to 45% margins over the past couple of years. I mean, those are the kind of numbers that some of us dream of that we could get. Basically, I mean, at the end of everything, before taxes and depreciation, they're getting 23 billion, up 20% over last year, most likely due to a slight increase in volumes, but also petroleum prices are up, iron prices are up, a lot of these prices are up, um, and so therefore their attributable profit is way up as well. What I really like about BHP's presentations is they split it into 4 groups, right? They have 4 main groups. They used to have several other small groups that they had, but they spun that off into a company called South 32. So if you own shares, you got a portion of those. But I really enjoy the fact that they split it out so easily in their presentations. You're able to see how much they made for the quarter, how much of the earnings is coming from that. And really what the margins are. So if you look at like petroleum, you're able to see 62% and vice versa. When you think about it, the margins on these things are absolutely absurd. Return on capital employed 29% and 31% in coal. I mean, that's just phenomenal numbers. And even 12% in petroleum. I mean, that's relatively good if you consider that. I'm a huge fan of waterfall plots. I don't know if you guys have ever seen some of my waterfall plots. If you haven't, I love making them. I make them at work all the time. But I think these things are so awesome because it really shows the transparency of the numbers behind everything if they're being truthful. And you can see the increase of what's going on and what's really controlling the increase in price. So in this case, it's mostly price of assets that they're selling or price of goods that they're selling. But of course, there's volumes that are either going up or down, or increase in efficiencies due to turnarounds not happening or whatnot. And really interesting to be able to see those sort of things. This one was kind of cool. You can kind of see what they're basically trying to do with respect to productivity. Not sure exactly what they're trying to get at. I don't know if it's mostly like they're just trying to make sure that their plant efficiency goes up, or that they're just trying to reduce overall plant shutdown, or what have you, or just trying to remove like non-productive time whenever they're trying to strip out certain segments of land or whatnot. But very interesting to see, and also very interesting to see their cost per barrel or cost per ton come down in terms of how they're continuing to keep their margins high and their return of capital employed really continuing to go up. I don't know if you guys saw in the past, in like one of the main headlight slides, that they're trying to get 20% return on capital employed throughout the entirety of the company by 2022. They're trying to get it above 20% plus. This is a really cool plot. So you can see first half is a dark blue. The lighter blue is the second half. And we're looking at operating cash flow. So you can see back in 2011, 2012, when prices were extremely high, they were obviously making a huge amount of money. But here in full year 18, I mean, they're back, close to where they were before the commodities crash in 2014 timeframe. So really looking at good free cash flow. Free cash flow is basically for the first half is the dark blue again. The light blue is second half of the year. Really coming up on a decent amount of free cash, comparing to where we were a couple of years ago. In 2011, free cash was 13, $14 billion. We're almost at that point. The commodities haven't reached nearly back all the way up to where they were. So that means they were probably investing a lot of capital to get to where they are. Whereas now they're probably a little bit more efficient with their capital, and their capital employed efficiency has really gone up compared to where it was. So margins are expanding. They're getting more dollars for every barrel that they're getting in terms of what's actually costing them to get it out of the ground, or tonnage for that matter. So you're really seeing where they're splitting throughout their entirety and where the capital is going. So you have like your normal cash flows, your maintenance, what they're actually paying out to shareholders, and what they're actually sending out in terms of investing in specific areas of the business. So that 50% payout ratio is probably something you've heard me talk about before. I think it's a really responsible thing for a company to do, because if a company's not necessarily making any money, I wouldn't expect them to pay out anything, because it might just put them in a worse debt or financial position just to pay a dividend. Anyway, really interesting conversation that we could have there. But looking at the balance sheet, I think this is a really cool piece of data because the balance sheet was starting to expand in 2011 into 2013, and they kind of kept it flat. But over the course of the past couple of years, they've really tried to get it down in terms of where they're at. So a 5% gearing ratio, or I'm sorry, uh, looking appropriately on the right-hand side, the orange is the gearing ratio. So it's climbing all the way up to 30% as equity was kind of coming down, which makes sense. But as equity is kind of coming up, and the debt is also coming down to below the $10 billion range almost, gearing has gone to close to 15%, which I think is relatively good in my opinion. I think this is also a really cool plot here. So movements in net debt. So you're starting in full year 17 with how much debt they had, which can be viewed here, 16.3 million. They had the free cash flow, but then they also paid dividends and everything like that. So they end up with basically where they're at, which is 10.9 billion. Really interesting piece of work here. I really like this because it's showing basically the capital efficiency that they have. They, back in the 2011 timeframe, yeah, they made their most profit ever. But like I said, they were investing so much capital that, weren't able to really see it. So their capital efficiency has really gone up over the past couple of years because they're almost, 3/4 of how much they were making back in 2017 or 2011, 2012 timeframe, but they're really only utilizing a third of the capital, if not less. So really interesting to see that. It's really interesting to see the breakdowns. They're spending close to $1 billion in terms of exploration and different major projects throughout. 0.9 million in the onshore U.S. business for petroleum, which they're spinning off, or not spinning off, but selling, if that makes sense. And I think this plot's really cool as well, where they're actually showing, their return on average capital employed, and you can kind of see throughout the entire business where their best money is, right? So, of course, if you're able to invest all in this coal piece of the business, then you might as well go after it and invest all your money here, because the money that you spend in, let's say, conventional petroleum is only going to get you 15%, and this might not necessarily be worthwhile. But I like what they have here, which is like a small orange line, which shows what the capital employed was back in 2017. So you can just start to see some of these efficiencies, and it could very well be just the fact that the prices are improving. Like here, it's showing improving prices, and also increasing efficiencies, which is probably record throughput. So it's driving essentially capital efficiencies there, which is pretty interesting. And that's pretty much it. And I think there's a lot of different other things like future, what's going on in the future, what they might be investing in the future, and sales in the back end of the presentation. But I'm really interested and really confident in the future that BHP is really showing. I don't plan on selling these shares, and in fact, if like the share price were to go to 20, I would buy it again, as long as they don't really change their capital framework, and everything remains the same. I mean, it's like owning Exxon in the 80s. It's one of the best companies that you can buy for natural resources, and they're really spitting out a decent amount of cash, and they're really trying to simplify their portfolio. I think they have like 13 or like 14. I mean, you just saw you saw this slide where it's basically showing all the different assets they have. They really are trying to shrink the amount that they have so they can focus and get a lot of value out of these massive mega projects rather than focusing on small projects throughout. And I think somewhere in here they talked about future exploration and some of the other exploration prospects that they have. They've drilled a bunch of exploration wells, at least I know in the Gulf of Mexico. They might have drilled some elsewhere. in terms of petroleum exploration, bunch of different other things like Greater Western Flank B, which is an Australian gas project, I think. And it's just a bunch of different cool stuff that's like sprinkled throughout the entire presentation. Of course, I love energy production, so natural resources and petroleum resources, I think, are something that's really interesting to me. And you can really see, a bunch of their different things. I think one of the cool things is in Mexico just opened up their side of the Gulf of Mexico for exploration, and also for almost operatorship takeover to really get their resources and petroleum resources back on track. BHP won a contract for Trion, which is a huge discovery across from I think it's Alaminos Canyon in the United States Gulf of Mexico, and it's a massive discovery. Very interested to see where and how effectively they bring those online. And a couple other items that they discovered in the U.S. Gulf of Mexico as well. This is reiterating, the full year 18 plan and what they basically are expecting to do next year. 18% return on average or return on capital employed. I think it's phenomenal, and a bunch of other different things in the background. Then I think it goes more into the appendix there. But so that's really it. I mean, third highest paying or fourth highest paying dividend stock, $310 or so a year. Might continue to go up as prices go up, and they continue to pay out over 50% of their earnings and earnings per share per year. Really interesting piece of business. I'd love to continue to purchase more. I think it's slightly pricey at the moment, but you think about it, they're earning about $24 billion this year. They continue to grow their earnings. Might be something that's worthwhile. Can't put down something that has something in a price to earnings ratio of less than 20. So it might be worthwhile for me to figure out at what price point I would buy back in. Of course, if it dropped down to 20, I know for a fact I'd buy back in, but I don't know exactly what point. Is it $30, $25, or is it $35 where I'd start to dip my toes back in? So more to come. Love to hear your guys' opinion on that. Like always, if you guys have any suggestions, there's a lot of suggestions for me in the comment section about creating a video on spreadsheets. And I think I have a couple, but maybe not how to build one from scratch and where I would build mine from scratch again. So I'll leave a pinned comment down below. If you want me to build a spreadsheet, just hit thumbs up on that. And of course, if you have any other suggestions, feel free to leave a comment down below, and I'm more than happy to interact with you guys and talk to you guys about that. So appreciate this. It was a long video, but I thought it was really cool to kind of look at what I look at when I look at these investor reports, and also listen to the webcasts that the CEOs and CFOs give on a quarterly basis. So thanks, guys, and I'll talk to you guys soon in another video.